And we are back for another live stream show, trying out the new software again. Hopefully things go more smoothly than they did yesterday. So the Dow closed today down another 3%, down 879.44 points, barely keeping above 27,000. So if you add up the down day yesterday with the down day today, that is now down over 6% for the Dow in the last 2 days. According to these articles from MarketWatch and CNBS, the Dow just logged its worst 2-day percentage drop in 2 years. Here are 5 reasons the stock market is tanking, blah, 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 with the Cerveza problems, or the CV, one of the main ones, but the global supply chain is still a main issue. If you want to read more about the worst 2-day slide in 4 years, according to CNBC, the MarketWatch article says it's the worst 2-day percentage drop in 2 years. The CNBC article says it's the worst 2-day slide in 4 years. So if you want to read the contrasting views, I will put those in the information and description sections afterward. But the main reason for this show is what you can see there on your screen. Now the market is starting to have a rate cut tantrum. Not a taper tantrum, not a repo tantrum, a rate cut tantrum. So this market is so spoiled. A lot of market participants expect the Fed to cut rates. And guess what? The Fed Fund futures, which predict rate cuts, are starting to accelerate, predicting a rate cut. According to Jim Bianco, who you can follow on Twitter at Bianco Research, he did an absolutely excellent interview, roundtables discussion for the Cerveza problem, CV, on Macro Voices with Chris Martinson and Miss Shedlock. I highly recommend listening to that for an hour. I think Dr. Ben Hunt was also on there. Jim Bianco has been putting out on his Twitter that the probability for a March rate cut has increased to 32%, which is a pretty big jump, but the real big increase for a Federal Reserve rate cut has increased up to 77% now for April. So, big rate cuts. A lot of financial professionals are now betting, more likely than not, on a Federal Reserve rate cut in April, although some people think that there could be an emergency rate cut before the next Fed meeting in March. And one of those may be what you can see there on your screen, this op-ed that came out yesterday. Let me get it up here so I can read it to you. It's "The Fed needs to cut rates now." And if you have not heard of Narayana Kocherlakota, I put the most important things about his bio so everyone can read it right below his name on the article there in big, fat, red letters. Former Minneapolis Federal Reserve Bank president from 2009 to 2015. That's what you need to know about this guy. So when he writes a Bloomberg op-ed article, the other eggheads at the Federal Reserve who have really bad track records, they tend to have confirmation bias, and they tend to really like what he writes. So if he is saying that the Federal Reserve needs to start cutting rates now to fight the CV problem, the Cerveza problem, because central bankers have this ridiculous hubris now. They think that they can fight climate change, they think that they can fight wealth inequality, and apparently they think that they can fight a virus now. Just ridiculous. A CV problem, a Cerveza problem. I did not say the full word, so hopefully this will not get demonetized. So the hubris of these central bankers, they're going to attempt it, but the global supply chain is really mucked up. It is a disaster that is not going to be fixed anytime soon. And by anytime soon, I mean more than 6 months probably. From the stuff I'm hearing about antibiotics, generic prescription drugs, penicillin, auto parts, you name it. I mean, at some point, the Fed may have to start bailing out some of these people that sell things on eBay and Amazon. I hope not. I'm kind of joking about that, but you know what? I'm sure there's some Federal Reserve economist that's thinking about it. Maybe Paul Krugman's actually already jotting it down and thinking about writing an article about it, about how that's the next stimulus, is to bail out the sellers on Amazon and eBay who cannot get in inventory, reselling things that they buy in China, reselling them on eBay or Amazon. Okay, so let me talk more about some other markets. The dollar index today did briefly drop below 99. So that was interesting, but right now, as of right now, let me just hit the refresh button. It is well above 99. It is at, let's see here, 99.12. So the dollar index did briefly drop below 99, but only briefly, only for a couple hours, and now it's above 99. So let me talk about this Federal Reserve article. former Fed article. Let me talk about this former Minneapolis Federal Reserve Bank president op-ed. He says the world economy is facing a material risk in the form of the CV, or pervasive problem. Of course, it isn't clear how much economic damage the virus will do, but it is clear from the damage being done to China's economy and the response of other countries to what's happening in China that the virus could result in a significant worldwide economic slowdown. I think he's being a little, optimistic. Such a global economic slowdown would likely lead to considering the problems with the global supply chain. And travel. I mean, look at the travel. Have you guys seen the stuff? Disney, travel, airlines, cruise ships, Disneyland. I'll talk about Disney in a little bit later. Such a global economic slowdown would likely lead to continued upward pressure on the dollar, which would drive inflation even further below the Federal Reserve's 2% target in the next couple years. This is totally ignoring reality, totally ignoring the real inflation rate. This is the government economic data, and they believe in it wholeheartedly, saying that there's not enough inflation. They're worried about a strong dollar causing not enough inflation. No wonder so many of these Federal Reserve PhD economists want to increase the inflation target and hope to overshoot the inflation target. Some of them would not mind if there's a 4% inflation target, and they well overshoot the 2% inflation target. The strategy now is stagflate and tax and lie. And people are going to have to be very anti-fragile. But this is a similar strategy. Lynn Alden has talked about this on her Twitter. She puts out a lot. She's a good follow on Twitter. I don't agree with everything she says, but she's very smart. And her point on this is that since World War II, the U.S. is using a very similar strategy, compared to what happened in World War II, where they're trying to increase inflation massively while also manipulating interest rates lower, with financial repression, and then eventually maybe even negative interest rates here in the U.S., although I think that would break things. But there are a lot of PhD economists and Keynesian academics who ignore reality and don't think it would break things. And I'm sure would blame someone else if they did break things. Okay, and a broad slowdown in the world economy would lead to lower U.S. employment growth as American businesses endure reduced demand for their goods and services. His benchmark forecast, the article writer's benchmark forecast, is that the U.S. economy will remain resilient to these forces, but there is a substantial risk that such a forecast could be wrong. One possible strategy is to wait until there actually is a slide in the economy before easing interest rates. Again, I don't think the Fed will wait. It looks like most market participants, and there may be inside information there on that betting, maybe from some of the investment banks, maybe some hedge fund managers that have certain former Federal Reserve employees as highly paid consultants. Wink, wink, nod, nod. The betting right now, and you can look at articles on this. You can search Fed Fund futures, and you can check on this every day or every couple days or once a week or something if you want to gauge what the Fed Fund futures are saying for rate cuts. Okay, but they are betting on, the majority of financial professionals now are betting on at least a 25 basis point rate cut. Some people think the Fed needs to do this overnight, step in immediately before the next Fed meeting. Rates are still only a little above zero, and so the Fed has few tools available to offset adverse shocks. In this situation, a basic precept of monetary policy is to keep the economy as healthy as possible in advance of downturns. As New York Federal Reserve Bank President John Williams explained in a speech last year, that means cutting interest rates in a preemptive fashion when threats to growth become more pronounced. Of course, it was exactly in response to the increase in global downside risk that the Fed cut interest rates by 75 basis points, or 3/4 of a percentage point in 2019. The Fed's rate-setting Federal Open Market Committee holds its next meeting on March 17th to 18th. I don't think the FOMC should wait that long to deal with this clear and pressing danger. I would urge an immediate cut of at least 25 basis points. Wow, at least 25 basis points. Arguably 50 basis points. Wow, this guy's turning into like Ben Bernanke here. That's a cheap insurance policy for the economy that the Fed shouldn't pass up. Watch when they do this, the dollar still doesn't devalue relative to the other currencies. Watch if they cut that and the dollar doesn't. Watch the reaction of some of these PhD economists. I'm not saying that's guaranteed to happen. I'm saying that the reaction of these guys would be pretty crazy if that did. Okay, and I guess that's it. He just basically got in a quick article of a couple paragraphs for why he thinks the Fed should immediately do a rate cut of at least 25 basis points. He thinks 50 basis points immediately, probably even before the next Fed meeting. Now, let me talk about some other things that happened today, very interesting. Today, the 10-year Treasury yield drops to a record low of 1.31% as the Cerveza problem, or CV, hits the global economy. So someone in the comment section of one of my video yesterday, the live stream show under the video, said that these the bonds, the yields on the bonds falling means that the bond market is crashing. That is incorrect. So when the price of a bond increases and there's demand, more demand for bonds, and more people are buying bonds, that means that yields fall. Okay, so that's basic finance 101. And so when there's less demand for bonds and more people are not buying bonds, less people are buying bonds, yields on bonds will rise, so more people will want to buy them. So demand for bonds inversely proportional normally for yield. That's finance 101. Okay, so with the 30-year US Treasury yield dropping now enormously, let me talk about this chart of the 30-year US Treasury yield. So on February 11th, the yield for the 30-year US Treasury was at 2.051, and now it is down a little over 2 weeks later, 14 days, down to 1.851. So the 30-year US Treasury is also enormously low. And now we have the 10-year US Treasury to a record low of 1.31. So what this means, and I've talked about this now for the last week that I was seeing in price action, is you have a lot of professional money managers, whether they're in the US, Europe, Asia, emerging markets, maybe they're in Switzerland, maybe they're in the Cayman Islands, they're professional money managers. And what they're doing is they're going to what professional money managers would call risk-off strategies. So this means cash, this means dollars, this means gold or gold-related investments, maybe some gold miners, maybe Franco-Nevada, maybe some select gold miners. Jim Cramer was pumping Barrick Gold, I think yesterday. I think it was yesterday. So, and then also the other one is treasuries. So those are the three main, the normal main quote-unquote safe haven, at least on a relative basis, safe haven plays. So when there is a crisis scenario, and this is normally pretty rare, the dollar and gold prices in dollars can go up. Normally, the dollar and gold prices in dollars do not go up together for a prolonged period of time. Normally, they tend to act inversely, but correlations can change. So normally when they go up together in price, they don't have to go up the same amount. They just have to be correlated. So if the dollar is going up more than gold in dollars, or gold's going up more priced in dollars than the US dollar and the dollar index, the correlation has changed to the normal correlation. That would be, to me, a crisis correlation. So more professional money managers are making crisis bets. They're buying hedges. They're playing it safe. And a lot of people on Wall Street, some people on, I've interviewed, if you don't believe me, go look in the archives. I've interviewed over 500 financial professionals. Many of them were investment analysts. They were professional fund managers. There were a good amount of hedge fund managers, a couple dozen hedge fund managers. And, you know, some of these guys own gold. Some of these guys don't own gold. A lot of them tend to not really like gold. Okay? The ones who have worked on Wall Street a long time tend to not really like gold. The ones who are still on Wall Street, they may own gold, but they definitely do not like gold. Because that means then that their other investments and the other things that they're trying to sell Main Street, normally stock mutual funds, bond mutual funds, other stuff, are not doing well. But a lot of people on Wall Street, financial professionals, and a lot of money managers will buy gold anyway because it's going up. I was listening to a podcast with hedge fund managers, Capitalist Exploits. Those were like those professional money managers, hedge fund guys like Cuppy and Chris McIntosh, I think. And they were talking about how some of these ETFs that were value ETFs were buying Tesla because it was going up. Okay, Tesla's not a value stock, But some of these ETFs and other money managers were buying whatever was going up. So gold is going up, and that means, or at least it has been now for the last month or so, and that means that a lot of professional money managers are paying attention to what's going up, and they're going to get some exposure to it so they can put out in their investor newsletter that they had exposure to something that was doing well, even if they hate it. And I've had interactions. I've worked in the financial industry now in different jobs for a decade. I've worked with old school value investor analysts and other financial professionals who are very old school who hate gold. They're value guys. They're like Warren Buffett. Although Warren Buffett did own a lot of silver at one point. But Warren Buffett, his comments about gold are very, very clear. There are a lot of financial professionals that hate gold but are buying a lot of it for themselves or for their clients now. And silver open interest now is at an all-time high. Let's see the silver price. Silver's barely holding 18. I didn't look at the Kitco, so I could take a look and see if that price is below 18 yet. There's been paper price smashes, but you know what? I think a lot of people now, a lot of professional money managers who don't necessarily like gold or silver, are buying the dips. I think they realize now that the global economy is going to have big supply chain problems, and that these problems are not easily going to get fixed in the next 6 to 12 months. So the bond market is not crashing. Okay, there's actually more demand for bonds because the value of the bond is going up and the yield is going down. So professional money managers are retreating into dollars, 10-year US Treasury bonds, 30-year US Treasury bonds. The yield curve is going inverted, so I don't think people want the short-term treasuries. Okay, let me check my notes and see if I got everything I want to talk about. Oh, the Disney CEO. So, finally, let's talk about Disney. So, Disney may be a somewhat unintended victim of the Cerveza problem, CV problem. So, the CEO, Bob Iger, of Disney just announced he's stepping down today, and it was kind of a surprise to many people, and his replacement was also a surprise. But Disney has some red flags there. Now, Disney stock is at a 4-month low, and over the summer, a lot of people aren't aware of this, but Francine McKenna, who I've had on my show, she's really good with accounting, although I disagree with her about Tesla's accounting, as do many other hedge fund managers. She got information and evidence from a whistleblower at Disney, and she published an article with a lot of detailed information in August 2019 about how Disney was doing accounting fraud. So that's been weighing on Disney for a while. Disney also has been having problems with their Star Wars brand. The Star Wars brand, besides The Mandalorian and Baby Yoda, a lot of the Star Wars brand, especially the movies, have not been doing too well. A lot of really hardcore old school Star Wars fans are not happy with a lot of the Star Wars content that Disney has been putting out. Also the park, the Star Wars park, I hear that was being in Disneyland, in the multiple different Disney locations in Disney World and in Disneyland, that the Star Wars part of the park was being boycotted, and Disney spent like over $100 million renovating it. Whoops. So Disney may be an unintended consequence of the CV problem, of the Cerveza problem. So 40% of Disney's revenue yearly is from people visiting the theme parks, which they've drastically increased the price of admission. I remember when I was a kid a long time ago, when I lived in Southern California, 20 minutes give or take from Disneyland, my mom bought annual passes, and then she dragged me to Disneyland when I was like, oh man, it was in elementary school and junior high, and I think it was $125 per year for a California resident, and you could go as much as you wanted. That was a very long time ago. It was over 20 years ago. It's like 25 years ago, give or take. And now the cost to go to Disneyland, I think it's $200 per person for one park. I think I just saw that. So the cost is enormously inflated. And, you know, with the CV problem, with the Cerveza problem right now, people aren't going to travel. People are not getting on airplanes. People are not getting on cruise ships. People are not going to fly somewhere to go to a theme park. So Disney is looking like a lot of red flags. So it looked like Bob Iger, even though he made a ton of money. And he did some great acquisitions too. He bought Marvel Entertainment, the MCU. That's a many billion-dollar cash cow, and Pixar. But the Star Wars, the problems with the Star Wars brand, that's going to take a while to rebuild. The Mandalorian and Baby Yoda are not enough to overcome some of the problems with the movies. So Disney, looks like Bob Iger is getting out on a sinking ship. I was talking with some professional traders in the afternoon, and they think that Disney is going to have some really, really bad problems for a while that are Cerveza problem related, among other things. They weren't aware of the accounting fraud scandal. When I brought up the accounting fraud scandal and sent them the articles, that only added to their short thesis. Now, I don't know if shorting is going to work on that. We'll see. They think it will. Maybe Disney will get a bailout. Who knows? Like Boeing and General Electric and Government Motors. Okay, let me look at listener questions and comments, and then I'll wrap the show up. Let me see how long I've been going for. 22 minutes? 21 minutes. Matsu Spock says a 10% correction is what Goldman Sachs and JP Morgan said for stocks. Yeah, because the investment banks tell the truth to for free to people. I mean, Goldman Sachs fleeces their own pretty high net worth clients. If you have like only 5 million or 10 million at Goldman Sachs, they fleece you too on high fees. Look at what happened with Eric Townsend on Macro Voices. He wrote a whole on his Macro Voices website, he has a whole thing about what happened, how he lost many millions of dollars from trusting money, his high net worth, to Goldman Sachs after he cashed out of his software business before the tech bubble burst. Jonathan says, according to Zero Hedge, the Fed won't rescue the market. Yes, because Zero Hedge is always right. I don't think Zero Hedge knows. We don't know. Look, the Fed could do more than just one quarter basis point rate cut or 2 quarter basis point rate cuts. There could be currency swap lines behind the scenes. We don't know. We don't know what the Fed's going to do. And I go back to this all the time, rule number 1. The politicians and the central banks will, if they're not getting the desired outcomes they want, they will change the rules. And I have friends who have gotten screwed over like this, hedge fund managers who have gotten screwed over like this. One of my friend, longtime hedge fund manager, longtime financial professional, over 20 years, I think over 30 now, and he had successfully operated a short fund for decades. He was making pretty good money shorting. And over the last 5 or 6 years, he just got absolutely killed, and I think his hedge fund just closed. And you know what? The last year or two, he was telling me some of his trades and what he would see with his research and how he would set up his trades. And what was funny is that things ended up playing out fundamentally with the companies he saw, like BlackRock and some of the others where the margins were going to erode. So some of these other money management companies where the margins were going to get destroyed. And guess what? The stocks didn't fall. They went up 30-40% and he got killed on his shorts. And now you have governments, which goes into rules changes again, talking about, not the US government, but other governments talking about banning short selling. Steve says the supply chain loss is 45%. No, I think the supply chain loss is more than that. So China is, 30% of all manufacturing, but a lot of the other manufacturers all over the globe all use parts from China. I think it's more than 45%. It is a very high percentage of auto parts in China and Wuhan, very high percentage of auto parts, of starting chemicals to make generic prescriptions, antibiotics, penicillin. Stock up on your generic prescriptions now. Aggregator says Trump told Mnuchin to hold the plunge protection team at bay and let the markets fall to force the Fed into a rate cut. Well, I don't know. Wasn't Trump just tweeting earlier today that it was bad the stock market went down? Jeff asks, what's the best way to hedge Corona? Corona beer? What's the best way to hedge the cerveza problem? Cash. Cash gives you optionality. Dollars. Cash gives you optionality. I think at some point, I don't know the exact timing on this. I've been telling my Patreon account contributors in a podcast, there's a lot of content behind the paywall now. If you want to sign up for my Patreon, there's over 300, I think, Patreon account contributors now. So thank you very much to everyone who's chipping in, $5 a month or more. Allows me to focus. I can do this free podcast and then also put other stuff behind the Patreon account paywall. I'll just give you an example of this. I won't name any specific company. So I think at some point, it's tough to say on timing, that there will be one of the best buying opportunities for oil stocks over the last 10 to 20 years. Maybe even more than that. I don't know when, but I know if I have some cash and I'm keeping it there and I'm waiting and I don't buy all my oil positions at once I start this, that I will have the opportunity to make big gains in oil. Okay, because at some point, if this continues and the global supply chain gets worse and the global economy gets worse and it takes China longer to come back online and Europe comes offline, this is going to keep kneecapping oil demand. And then you have also on the supply side, you have the Texas oil producers in the Permian who are still producing more oil. So they're still increasing oil production in spite of this. In spite of the oil price and what we've seen with oil demand, because of cerveza problems out of Europe, especially out of China, oil production here in the US is still increasing. So there is going to be probably now an even bigger bust in oil. Tough to say when on timing. If I knew when on timing, I probably wouldn't be doing this podcast. Well, maybe I would. I'd probably still be doing some free content. I don't know if I'd be doing this as often. The timing on this is going to be difficult. But when there's more and more bankruptcies, and the amount of bankruptcies increases, and there's blood on the streets, and some of these really good oil companies, the baby is thrown out with the bathwater, that's going to be the time to go in and buy. Because there's going to be bad oil companies that are going to go bankrupt first, and then there's going to be the good oil companies that are going to survive this big bust, and they're going to be discounted 50, 60, 70, maybe even more than that. And that's going to be the time to go in and buy. But you will not be able to buy those things if you do not have cash and you are not patient. So, what are you waiting for? How can you hedge the cerveza problem? One of the best ones is cash. Cash gives you opportunity. The people who had cash in 2008 and 2009, the bargains were incredible. There were amazing stocks on sale. When my grandma passed away and the stupid stockbrokers and insurance salesmen had fleeced her and sold her mortgage-backed securities for years after my grandfather had died, and she didn't have much of an education, a financial education, she got basically raped and pillaged, and we liquidated her mortgage-backed securities for what we could. We had cash in 2008 and 9, and we didn't buy anything immediately. We waited because things were still going down. And then we started to buy with the cash. And one of the stocks we bought, I'll just give one example here, was Buffalo Wild Wings. And I think I got it for $20. I think Buffalo Wild Wings back then in 2008 or 9, I want to say it was $20. It dropped down to like $20 a share. And then within about 2 or 3 years, it was $140. It went up sevenfold. Okay, but if we didn't have cash, there would not have been the opportunity to make those purchases. So if everything does crash, or a lot of things crash, or the oil market crashes, you want cash. You want to have those dollars for those opportunities. If you don't have any cash, you don't have any optionality. You have less options for what to buy if things actually do go on sale. Andrew asks, wasn't silver wheaten $4 during the 2008 crash? It might have even dropped a little bit below that. I actually know someone who sold his car, he sold his furniture, and he bought as much, and then he bought silver wheaten on margin because he had a job. But he bought silver wheaten, as many shares of silver wheaten as he could on margin at like $3 or $4 a share, the lowest possible price it was in 2008-9. And he made over 10-fold gains plus the margin. I don't recommend doing margin, but you get my point. I would not play with margin like that. But the cash is what allows you to have opportunities like that. If there's a buying opportunity for a specific market, it looks like the oil market is going to get absolutely kneecapped because you have a situation where supply is still increasing, especially out of the Permian, and demand looks very dicey on the demand side for oil. Because the Chinese economy, it's kind of a little bit of it's restarted from what I'm hearing in Wuhan. A little is being allowed, but then what could happen then in Wuhan with the restart is this 40-day plus quarantine could be wasted. So you have the local Wuhan government that is desperate for tax revenues. They need economic activity. You have a lot of people said they need to pay off their debt. They need the tax revenues. So they need economic activity. And then you have the people in Wuhan. A lot of people in Wuhan, businesses and individuals, did not have a lot of cash reserves. They need to restart. There's a lot of sad stuff from Wuhan. It's going around it's going around social media. Jennifer Zhang is monitoring Chinese social media, and she's putting the stuff up on her Twitter. The stuff is really, really sad out of Wuhan. There's families that had to give up children to the orphanage because they can't feed themselves. It's the stuff out of Wuhan is tragic. But if they do restart economic activity too soon, and there's mass gatherings of people in Wuhan because of the trying to restart the economy at factories and restaurants and shops, and those mass gatherings of people, the restart of the pervasive problem could start again. Bill says the U.S. is hiding the numbers big time too. Yes, I agree. But the difference is the U.S. doesn't have crematoriums. At least not yet. Hopefully never. But yes, all governments lie and only tell the truth when it's convenient. And the lies are to different degrees. I don't pay a lot of attention to intraday gold miner moves. So if you're day trading gold mining stocks, you're playing a dangerous game. So a lot of comments in here. Why are these gold mining stocks falling? I don't pay a lot of attention to the intraday moves of a lot of gold mining stocks. I don't like day trading those things. This is why you don't buy all of your position at once, because you can't perfectly time the market. There's people that claim they can. Should never buy all of your position all at once. Just my opinion. This is why if there is a big bust in oil, someone's going to come in there. They're going to listen to this podcast, and like a couple months later, they're going to go in there and they're going to buy all of their oil positions all at once. Even though I never said to do that, never buy your positions all at once, then I'm going to get a 10-page long email telling me that they did it anyway and how can I help them for free. Never buy all of your stock position at once. You can't perfectly time the market. Stacking Assets says he thinks the dollar rally is about done. I don't know about that. It depends what the Fed does. It depends how much worse things get with the global economy, how much worse things get out of China, because we're obviously not getting the truth out of China. If things get a lot worse in China and a lot worse in the European Union with this pervasive problem, the global economy goes to total disaster. Like, let's say the supply chain breaks, like totally breaks. Like, it becomes obvious to everyone that it totally breaks. The dollar could rally more. But the Federal Reserve, the Treasury, President Trump, the Trump administration do not want the dollar to rally more. So at some point they may step in and do intervention. And again, this goes back to the rules changes. Bill Ross says the World Health Organization is so sick they only care about money and let the pervasive problem spread. Well, the Chinese government wouldn't even let the World Health Organization into China. So they wouldn't even let them into Wuhan now. I don't even think they're allowed in Wuhan yet. So initially they weren't even allowed in China, and then they were only allowed in other cities. But the Chinese government controls the World Health Organization. Go watch the podcast China Uncensored, China Unscripted, ADV China. They're doing a fantastic job on a lot of their coverage. I just heard that China Uncensored's not only getting videos demonetized, they're having videos removed. Screenshots are on their Twitter. China Uncensored videos are not only being demonetized, they're also being removed. Anthony says the World Health Organization is wildly corrupt. I agree. China Uncensored did a show on this in the last week, and they showed that the World Health Organization steals over $800 million for first-class plane trips, first-class plane tickets, and five-star hotels and other wastes. So the best hedge for the pervasive problem, in my opinion, is cash. Because if you're short something, this is hypothetical, if you're short something, and then all of a sudden there's a government stimulus plan, or all of a sudden short selling is banned, you could be in trouble. Does this list the super chats on here? Okay, I do. Okay, it doesn't separate the super chats. I don't know why. Oh, Dimitri sent me a $5 super chat. Thank you, Dimitri. Oh, Dimitri, did you get in touch with Mark Nessman of the Nessman Group? Because remember, you asked about that because you were looking at either getting rid of your U.S. citizenship or moving your assets out of the country. Mark Nessman of the Nessman Group. He's the main expert at that. Okay, so Dimitri, I don't know why this new live chat, this new live streaming software that YouTube has, it doesn't separate the live chats. So then I have to screen through. Been talking now for over 38 minutes. I have to screen through all of them to look for the live chats. They should just be separated. I don't know why it's not doing that. That's if any YouTube people are listening and any monitoring my my content now. Okay, so let me read the super chat here. Jason, I don't think there is much more to go, judging by the 2-year, 10-year struggle on the yield curve. The system only has a few months left. Maybe, but what if they print? What if the Fed opens up the swap lines? What if those Chinese small business owners? What if the Fed agrees to if there's some type of trade deal negotiation similar to the Plaza Accord? And the Chinese government gets trillions of dollars in currency swaps, and the U.S. gets intellectual property or other trade concessions. That helps Trump win the 2020 election without the stock market crashing. Again, that's just hypothetical. We don't know rules changes. So yes, without further interventions, things could get a lot worse, but we don't know what's going on behind the scenes. Remember, things were about to crash. For those of you who weren't paying attention, in November 2018, things were really close to crashing then. That was pretty much the last time we got pretty close to crashing again was November 2018. The stock market was down almost 20%. GE had gotten a credit downgrade and the bond markets froze up. The new credit issuances and the junk bond market froze up. There were no new credit issuances for 40 days, and there was at least 2 emergency meetings between the plunge protection team, the Federal Reserve, the US Treasury, all the alphabet soup of regulators. There was the one that Steve Mnuchin botched the press release for Christmas Eve 2018, and then there was the other emergency meeting that TheStreet.com reported on in April 2019. So we don't know what's going behind the scenes with emergency meetings. This is what I'm talking about with rules changes. You think you have things figured out, like Dimitri has things figured out now, but all of a sudden, there's emergency meetings over the next week, and then there's a new currency swap program. Or mark-to-market accounting is now not only with the banks, it's now suspended for Boeing. It's now suspended for Disney. We don't know. Okay, this is the danger, because there's professional traders on Twitter telling me that Disney is going to collapse. The stock is going to collapse even more. Okay, well, how do we know that there's not a secret bailout or something? These large corporations get enormous advantages. Okay, I got another super chat from Wally. Saw a Real Vision video on the repo market. I saw the same one. That's Raoul Powell's. It just got released for free today. They said that the real action in repo occurs in the Treasury General account. What do I think? I think it's a lot more than just that. But there is $400 billion as of when that video was created a couple weeks ago. $400 billion in the Treasury General account. George Gammon, my buddy George Gammon, has covered this. So that is a lot more ammo for President Trump and Steve Mnuchin, the Treasury Department, to do their own version of QE in the Treasury General account. No, repo was a lot more problems than that. There were foreign banks and hedge funds and foreign governments in the foreign reverse repo pool. There was over at least $300 billion in the foreign central bank reverse repo pool that was earning a ton of extra interest, and the Fed was letting it happen and not giving any American pension funds or savers extra interest. Anthony said, oh my God, Anthony. Anthony's funny. Anthony says, when shit hits the fan, you're going to want more toilet paper. So you're stocking up on like the fancier stuff with the Charmin Ultra Strong or Charmin Ultra Soft? There's a lot of shrinkflation in those. I covered that in the last year. There's a ton of shrinkflation. You're getting a lot less Charmin Ultra Strong and some of the other name ones. Yeah, so the repo problems, it's not just the Treasury General account. The primary dealers could not, all the smaller, there's 24 primary dealers. The smaller primary dealers could not afford to buy all the treasuries at the Treasury auction that the U.S. federal government was selling last year over the summer. They couldn't afford to buy them. So what the primary dealers did, because they were contractually obligated, they went in and borrowed in repo to go buy the treasuries. And then there were hedge funds that had enormous leverage bets on the 10-year U.S. Treasury yield, in my opinion. And they made bad bets on the 10-year U.S. Treasury yield that went up 26. The yield went up about 26% in 10 days. It happened 10 days before. It started 10 days before Repo Madness became public on September 17th, 2019. So there was about 4 or 5 different things going on in the repo related to repo, and they all started to go bad at once. That's why the Fed got screwed. It wasn't just the Treasury General account. There was a liquidity problem and a collateral problem. There was both. I know experts like the guy from Macro Voices, Jeffrey Snyder, so he was like, it's a collateral problem. There was a liquidity and a collateral problem because the liquidity problem was a dollar shortage related out of the U.S. Okay, well, that's enough for tonight's live stream show. I want to thank everyone for listening, and thank you very much to my Patreon account contributors. If you want to try it out, it's only $5 a month, and there is a lot of audio podcasts and a few written articles behind the Patreon account paywall on topics I do not discuss on the free live stream. Also, thank you very much to my 10 or so monthly PayPal contributors and people throw me a tip once in a while. I do take the top 6 cryptocurrencies.